Everyone seems to think that the dollar is going to collapse in one single catastrophic event. But that's not how this story ends. The death of the dollar looks more like controlled demolition, flight to safety, and an irresistible pull, like the gravity from a black hole that keeps demand for dollars growing. It's starting now, and the world is signaling a shift. And while the dollar is inevitably going to lose its throne, it's not happening in the way most people expect. The signals about what is actually happening are everywhere, and if you're paying attention, you can see it too. First up, we're looking at a chart of the dollar index, the DXY. This value is calculated by looking at the value of the dollar compared to a basket of other currencies around the globe. This chart goes back to 2008, and you can see since the financial crisis, the dollar has been getting gradually, and with volatility along the way, more and more valuable compared to other currencies around the world. From 2007 to 2014, we can see the dollar index was range bound between the 75 to 90 level. When it finally broke out, it got locked into a new trading range in between 90 and 100. And that lasted from 2014 through 2022. And when it finally broke out again, it broke out into the range we see now in between 100 and 110. If we zoom in recently, you can see that the dollar index has declined substantially since the start of 2025, or in other words, the inauguration. This short-term drop in the value of the dollar relative to other currencies is happening as a result of the dollar being less valuable to other currencies because of tariffs. Tariffs very simply make it more expensive for a nation to purchase things from other nations. It makes that currency less valuable. Now, the second part of this is that if you can make dollars less desirable to hold on to by foreigners, then some of those dollars can make their way back into the United States, which will prop up asset prices. But the big piece that we're seeing right now is a flight to safety. If you look at the price of gold, you are seeing a signal that capital around the world is flooding into safety. And as you can see from this chart here, gold as a percent of global international reserves have been growing for years now, while foreign holdings of treasuries as a percent of government debt has been declining. This doesn't mean that foreign buyers of US treasuries are completely gone. It doesn't mean that there is no foreign demand, but it does mean that as a percentage of assets held, treasuries are less and less attractive, and gold is becoming more and more attractive. In other words, it's out with the old, in with the gold. And this is the first important note about what de-dollarization actually looks like. It is a slow and controlled reduction in exposure to the reserve aspect of gold, which is treasuries. This is not something that happens overnight, because if you tried, you'd just kill yourself. So large foreign entities are slowly but surely reducing their exposure to US government debt. And we can see this in the rise of interest rates as foreign buyers of US government debt leave the market. Demand is dropping, which means rates are rising. But there's that old pesky issue that I mentioned before that keeps demand for dollars around with a force that acts as strong as a black hole's gravity. And that is dollar-denominated debt, and it is a $100 trillion force. And it will not go down easily, nor will it be a smooth ride. There will be incredible volatility as a result of this $100 trillion bomb. Now, if you're worried about some of the uncertainty in markets right now as a result of the craziness in this bond market and plenty of other things going on, and you're just wondering, how in the world do I even just protect my portfolio? How do I keep on making sure that I'm profiting along the way? And I'd like to invite you to join me this Thursday, June 12th at 7 p.m. Eastern time for my Black Swan trade event. It's a completely free event. I'm gonna show you how I've used Black Swan trades to take home returns like 1,700% in as little as 11 days on a market event that very few people saw coming, and why I think this may be one of the best plays to get into right now. And I'm even going to give away a signed copy of The Black Swan by Nassim Taleb, and it's signed by him. This book is worth hundreds of dollars. But this may be your last chance to register, because this event is hosted on Zoom and spots can fill fill up quickly. So all you have to do to secure your spot, click on that link in the description below. Register for my event. It's coming up very soon here on this Thursday. It's June 12th at 7 p.m. Eastern time, and show up for the call. As always, it's completely free. Spots are limited, so don't wait. See you there. Right now, dollar-denominated debt around the world exceeds $100 trillion. Most of this debt is in the shadow banking system. In other words, it's completely impossible to do a full audit and see where all this debt is, who has it all, who owes it all, what the interest rates are, what the maturities are. But there's good estimates that it's at least 60 trillion, probably well in excess of 100 trillion. Now, what do I mean by this? This is debt that is denominated in dollars. You're an individual, a company, a country around the world, and you want to borrow money from somebody because you want to spend that on something that you think will produce more income, more jobs, some growth. But the lender doesn't want to give you money that you can control, so you and the lender agree to borrow dollars. Now, the lender has dollars because they've engaged in some other commerce and they got dollars from somebody else. So I want to borrow dollars. I'm going to borrow dollars from him. Has nothing to do with the US, has nothing to do with the Fed, has nothing to do with the US government. There are dollars all around the world, and they are being borrowed and lent to each other, just like we do that here. There's this weird misconception out there that if somebody's in another country, they can't actually lend money into existence or borrow money because they're not the Fed. It's like, no, when you go to the bank and you borrow money, when you go do your job and you get paid dollars, like you don't have to be the government or the Fed to do that. Anybody around the world can get dollars. And that's happened to the tune of about 100 trillion. Now, the key thing here is this is debt. And the way that debt works is that debt loans money into existence, which means that every dollar that exists has been loaned into existence. And the hard part to wrap your head around is that every time that happens, it creates even more future demand for that money. Because when I borrow $100, now in the future, I have to go get $100 from somebody else plus some extra dollars, $105, $110, depending on the interest rate. So every time debt is created, it creates more demand for more dollars in the future. Now, this can go wrong at any moment. One spark can set off a deflationary death spiral around the world, evaporating dollars left and right. Because let's say for whatever reason, I'm a company, I roll out a bad product, I can't pay my debt, I default, I go bankrupt. Let's say the bank that I borrowed money from was really needing me to pay that money back. Suddenly, they don't have the dollars they thought they were going to get, so they can't pay dollars to who they owe dollars to, in this case, depositors, because they're a bank. Well, there's a bank run, the bank collapses. Now, everybody else who had dollars at that bank can no longer pay dollars to who they owe dollars to, because their money that was at the bank is not actually there. It's gone. It's evaporated. It doesn't exist. This is how a debt default spirals out of control, because it's like a chain of dominoes. One person can't pay their debt, it starts wiping out everybody in line, and all those dollars that everybody thought were there are not actually there. Now, a couple years ago, we all saw how this plays out in the United States. There was a bank run, Silicon Valley Bank collapsed, and the Federal Reserve printed up all the dollars that had already ceased to exist to replace that money that had disappeared, making the depositors whole. But the scary part is, central banks around the world don't have the ability to do this. They can't just print up dollars to bail out their own banks. So instead, they have to call up the Fed and tap the swap lines and get dollars from the Fed in order to bail out their own banks. In fact, this happened just a couple of years ago with Credit Suisse. They were on the verge of collapsing. They had to get bailed out by the Swiss central bank. But the Swiss central bank didn't have enough dollars. And so the Swiss National Bank had to make a large draw on its Fed swap line in order to get those dollars to bail out Credit Suisse. If you don't see the pattern yet, de-dollarization looks like demand for dollars growing to the point where there are not enough dollars sufficient for that demand. A default then happens, and it will lead to a deflationary spiral, like dominoes knocking out dollars across the system, unless there's an injection of new dollars that can actually only come from the Fed. Those new dollars then replace the assets on balance sheets and slowly make their way into the system, driving the value of the dollar relative to goods and services down. Which is why you see charts like this with dollar usage around the world actually going up. Dollar usage from SWIFT shows that dollars are being used at a record high. This is how Gresham's law works. Bad money drives out good money. In other words, if you have two forms of money, you're going to want to save and hold and hoard and reserve the one that's going to preserve its value the most, and you're going to want to spend the one that you know is worth less. So you're going to want to hoard your gold and you're going to want to spend your dollars. In other words, dollar usage going up is exactly what you should expect to see leading up to the death of the dollar. Not something that happens overnight, but something that happens over a long period of time with volatility along the way, with demand for the dollar continuing to increase over time. And eventually we get to a point where governments, even the United States government, will not be able to afford to borrow just dollars anymore because the interest rates will be too expensive. And that is when you get the reintroduction of gold bonds or things maybe even like Bitcoin bonds, where the US will repay the dollars that they borrowed, determined by the price of the asset that is backing that debt, like the gold or the Bitcoin. This will mean governments will be able to borrow at very attractive rates because there's built-in protection from real inflation. If the price of gold goes up because of too much money printing, then as the lender, you are protected. You get back the appropriate number of dollars for the price of gold or Bitcoin. So the interest rate will be able to be very low. So governments will be able to borrow at a very attractive rate. It will also force financial responsibility because if they continue to print and spend wildly, that will drive the cost of their debt sky high. And once this starts somewhere, governments will be very, very hard pressed to borrow with anything but collateralized debt, like gold bonds or Bitcoin bonds. And once we get to that point, gold or Bitcoin or whatever asset is being used to back up the debt has essentially been monetized or remonetized. This is how the dollar dies, with a whimper, not with a bang, but with massive, unpredictable volatility in both inflation and deflation along the way. And if you'd like to know how I am preparing for this uncertainty with my portfolio, don't forget to sign up for my Black Swan trade event. It's coming up in just a couple of days. Link is in the description below. As always, thank you so much for watching. Have a great day.